Hopefully you guys are out there. Let's see. We're doing comedy routines here. Let me see if I can pull everybody up. All right. So hopefully everybody's falling into the room. I can't see the number. There we go. There we are. All right. So everybody going in. If you're here for Tax Tuesday, you're in the right spot. And I'm going to take the gray
And
away.
some people coming in.
There we go. Yeah. All right. Good. Our technology is working today. Yep. Nope, nobody here. All right. All right. So welcome to Tax Tuesday. If this is your first Tax Tuesday, we've already started an auspicious beginning. Give me a thumbs up if this is your first Tax Tuesday and you've never been to a Tax Tuesday before. I imagine that we have a lot of old hats here. Oh, there's some new ones. Well, if you're new, welcome to Tax Tuesday. Wow,
Yeah.
there's a bunch of thumbs. Either they forgot that they've attended, or they really are first-time attenders. It's great to have you here, and I'm excited. Wow, this is good. Hey, wait, I got a button. Yes. And they gave me my What's Up button, which we might use under extraordinary circumstances. We'll see.
Like the first three questions.
The first three, like I got to get it out. I got to give it out. We got some buttons here. All right. So I'm Toby Mathis, and this is
Elliot Thomas.
And we're going to be your hosts for today. The Tax Tuesday is about delivering a little bit of fun with taxes so that you're not scared of it and that you actually realize that the tax system really is kind of a game. You're going to, the rules are, you got to follow the rules, and then you're allowed to put yourself in a situation where you pay the least amount as required under the law. There's no reason to leave a tip. And although they might be tax-free,
Right.
yes, but the idea is to keep more money in your pocket. And they're supposed to be fun. So Elliot usually drinks a lot before we start. So he's useless, useless. No, he doesn't drink. I should. That was on my things to do this year. But you just go ahead and ask questions. We have a whole bunch of accountants on. I see Troy, Tanya, Rachel, Jeff, Jared, Dutch, Arash. Oh my gosh, we got a lot of accountants in the Q&A area. And when I say accountants, I mean accountants like CPAs and I think we have tax attorneys and we have accountants in there to answer your questions. It doesn't cost you anything, guys. Go ahead and ask questions. Get them out there and we will absolutely answer your questions. This is a public service that we try to do. And then you can always email in questions to Tax Tuesday to Anderson Advisors during the week. Elliot here fields, how many of those do we get?
Anywhere from about 150 to 250.
Yeah. Elliot gets applause, and then he picks 10 of them or thereabouts to do live on these shows where we actually read them and go through them. And the whole idea, guys, is to take the snottiness away from tax and make it so it's actually fun. Somebody says, so I could charge $1 and give $4.99 for tip. Yeah. Yes. 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 Is this for accountants only? No, we like accountants. Actually, we really like accountants.
Yeah.
But this is for anybody. And we use regular language. So you should be able to walk away and understand things. And speaking of understanding things, let's dive in. Holy credoli. What do you got here? Let me see if I can actually. Oh, wait, I have a bigger screen right here. Hi, from some engineering professors from ISU, extend our greetings to you and your guests. So there's a whole group?
Yep.
Is that Iowa State?
Iowa State University.
Thank you guys. Welcome.
They beat Iowa.
They beat Iowa?
This weekend, yeah.
Oh, you're from there, right?
Yep. Mm-hmm.
You're like putting them on the front of the line.
They were good, relevant questions.
Yeah, all right. Yeah, those were right. We got good questions. All right. We all have CPAs, but we don't have as much trust in them, so we want to pick your brain. Your CPAs are out there like, hey, I heard you got this group of professors that are talking schmack. No, I don't blame you. It's always good to get a second opinion. So we'll answer your questions. Let's see. Wow, we have a whole bunch coming through here. All right. Professor 1 has 3 short-term rentals. That's what STR is. 7 days or less. And we'll explain what that means. He generates 20K of profit from each one, but each generates 60K of losses, cost sag plus bonus depreciation. we'll go through all of this so that if you're first time here, you don't get nuked on your first question. Can he use 20% QBI? This is great for the, it's what, 99A, but anyway, can he use it on the 20K profits, or will those be offset by the 60K losses and the net will be $40,000 each? We'll go over that. What did you do? I don't even know what to do. It's like, here's,
Touch of a button.
yeah, I think I'm gonna have to go like, I don't even know what to do. All right, well, Professor 2 has 4 long-term rentals and he used line depreciation for all of them. We'll explain what all this means, guys. His wife is rep or a real estate professional, but there's not enough losses to offset his 300 grand in income. The CPA suggests putting 200K in a syndication as an LP. K1 will generate $150,000 of losses. And as long as his wife is rep, he can use those passive losses to offset his W-2. Is that true? Really good question. So like, I got to just give you a little bit of, that's insane. There's more.
Well, there's a lot more.
Okay. Really should start day drinking before this. All right. Professor 3 has 1 passive long-term rental and just bought 2 short-term rentals with 7 days or less with costs sag plus bonus depreciation. Next year, 2025, his wife plans to retire and claim real estate professional status, rep status. The plan is to keep those short-term rentals as Airbnb, but with 8 days or more, AKA passive, and keep the long-term rental as is. The first question is, can the wife manage, clean those Airbnbs and claim the 750 hours without touching the third long-term rental that is far away and group them all together? Boy, this is intense, right? You guys, we're going to answer these and you guys are all going to get an honorary CPA designation. I don't know, EA probably. The second question is whether we can still use the losses from the cost sag we conducted on those 2 short-term rentals this year. The confusion comes from the fact that math was divided by 39 and now both are 27 years or 27 and a half.
I think there's more confusion than just that, but yeah.
These are cool. Like I'm actually thinking about it now. Gotta stop doing that. Don't think about it. I'm like wanting to answer right now. And I'll just refresh. Let's think of something not tax related.
Pizza.
Yes, let's think about pizza. All right. I want to think about pizza. All right. Now we've cleared the brain. All right. I have a question about capital gains tax. I'm selling a property with an installment payment plan. Only 2 installments to be received. The first will be received December of 2024. The second and last payment will be January 2025. How will this affect my capital gains tax? Interesting. Somebody smart. All right. Paying tax on real estate long-term gain. If my net income is under 93,000 in 2024, will I owe taxes on long-term capital gains from the sale of real estate, a vacation rental? The gain itself is over 93,000. So we'll answer that. How do I reduce my tax liability as a flipper? Then we just do the open-ended. We like it. We'll do the open-ended. Reverse exchange 1031. My God, I don't think I've ever had a reverse exchange question. Please help us understand it. How do I choose a QI, which stands for qualified intermediary? Any recommendations for first-time 1031 exchangers? Thank you very much. Great questions, man. Is it possible to use solar credits against passive income from real estate rent income? These are good. Like, did you just get hammered by these?
Yeah, it was quite a flood this week.
How do you determine if a repair in a rental property can be treated as an expense in the current year or must be depreciated? Wow. So this is a good one. And then this is the last question that we'll answer. And we'll get to these in a second. If your first time, we go through all the questions so you know what's to be expected. And then we just answer them. Hi, my husband and I want to sell a new construction home business to become full-time investors and manage our 5 large commercial properties. In the past, we've had real estate professional status because we self-managed our commercial properties. If we sell our construction business, do we still qualify for rep status if we start a management company to manage our commercial properties and earn W-2 income from this new company? What type of entity would be best to set up a management company? LLC, S-Corp, or C-Corp? Great questions. I mean, just like really good, solid, mind-numbingly good questions. Like these are, whew, we'll get into them. So thank you to all the professors out there for teaching those students engineering. I always say that the English majors are subsidizing the engineers. Basically, there's a disparity in the value of those two. No offense, but
Sure, none taken.
I know the engineers are like, they kill it. They come out, especially the computer engineers, but any engineer.
Right?
And I'm always like, man, they're paying the same price for the tuition. This one's, they're going to make 300 grand coming out of school. And the other one's going to get 30,000.
Yeah, I got a D in English, so.
Not surprising. Not surprised. Okay. Hey guys, there's whatever this is. YouTube. There we go. We have YouTube. That looks like my channel. Join my channel. There. This is just free. And just subscribe. And we also live stream this on YouTube. So if you're on YouTube, thank you for being on our YouTube. Absolutely free. Share it with as many people as you can, because frankly, financial literacy is something that we need a lot more of in this country. It'd be great. Clint Coons, my partner of, how long have Clint and I been practicing together? I guess it's 25 years now. So he does a great job doing asset protection. His channel's a little more geared towards real estate asset protection. Mine tends to be a little more geared towards tax and financial. And I've been losing my mind lately and doing a lot of rules of money because I can't help it. And people seem to like those. And I like them. So I like just doing those. So together, we're pretty good. If you want to learn how LLCs and all the things that we're going to be talking about today work and learn tax strategies, join us at a tax and asset protection event. The virtual ones are free. The live ones have a small ticket cost. I think it's usually less than a couple $100. And you can come spend 3 days live with us. We have one coming up in September this month. We have one coming up in December. And these are going to be a lot of fun. If you haven't been to one, you're around a lot of investors. It's usually several hundred people. And we just get around and we talk a lot about real estate taxation, real estate asset protection, legacy planning. We bring in a bunch of different groups that talk about things like cost segregation, different types of tax strategies. We always bring in Spartan, who does a great job on self-storage. And they've just exploded over the last 3 or 4 years. It's a lot of fun. So if you can, join us. And if you just want to do a virtual event, it looks like we have 2 coming up on the 14th and the 21st. They're absolutely free. And I would strongly recommend that you learn that subject, because it's really like making money is the easy part. Keeping it's the hard part. You'll realize that's true as you get better and better at making money, and you realize you have holes in your boat. You'll be a little ticked off, or your bucket. You'll be like, why is there always a hole in my bucket? And if we can clog some of those up, like our friends, the professors here, your money goes a lot farther. All right, let's have some fun. Professor 1 has 3 short-term rentals, 7 days or less. You're going to have to break this down.
Yep.
Like, definitely. He generates $20K profit from each one, but each generates $60,000 loss. Cost seg plus bonus, depreciation plus overhead expenses. Nice. Can he use 20% QBI for the 20K in profits, or will those be offset by the 60K losses, and the net will be $40,000 loss each? What say you?
Okay, so normally I just go out and blur out the answer, but we really do have to step back and kind of get the table set here a little bit. What are the STRs? Short-term rental. So if there's a short-term rental, there must be a long-term rental. The two are really under the code completely separate and unrelated. That's one thing we just want to take away at the beginning of our talks today here, all these questions, because that's going to come up a lot. Short-term rental, there's basically, I'm going to say 3 types for our purposes, but there's one that we usually use most of the time, and that is if the average stay throughout the year is 7 days or less. If we meet that standard and our average stay is 7 days or less, and if we materially participate, which means we basically do all the work or a lot of it, managing it, self-managing, etc., then we can change it into what we call non-passive activity or active, either way, as opposed to being passive. And the reason we care about that, if it's passive, which is, by the way, the natural standing if you have a long-term rental, but we are in the short-term rental world here. If it's passive, you may get a lot of losses from these things that we have listed here, the cost seg, bonus depreciation, overhead expense, and we'll expand on what those exactly are as well. If you have that loss and it's passive, most of the time you're going to be limited. You can only use a passive loss against passive income. There's a few exceptions like anything in the code, but that's the general standing. So you could have a lot of losses as we do here. We have 60,000 of loss for each of these 3 buildings. It's going to create a loss. And if we're not actively managing this, materially participating, and it's not a short-term rental, then we can't take those losses. So that's really critical to understanding as we go through not just this question, but a lot of the real estate related questions. Now, with that in mind, cost segregation, it's just a form of depreciation. Your normal status when we depreciate, if it's a short-term rental, is over 39 years. We only do the building. We don't depreciate land. So let's say we bought a building for 500,000, 100,000 for land. You divide the 400,000 building by 39 years. That's what we call the straight line depreciation. And you take an equal amount each year, except for the first year, depending on what time of the year you got into the venture. And that will be a big deduction. However, cost segregation is a type of depreciation that says, hold on, that building has a lot of components. It's got carpet, lights, framing, all kinds of different things going on. And each of those on their own have their own depreciation life. So cost segregation is a study. A group comes in, they say, well, let's break it into its components, 5-year property, 10, 20, and some will be 39 years in the case of a short term. That speeds up our depreciation. We get to take more right away. Then we could hook onto there something called bonus depreciation. Right now that says, if we did it here in 24, 60% of all of that property that's 20 years or less, we can deduct 60% right away. So you get this massive deduction. And so I'm not surprised that we're seeing deductions here of 60,000 losses. That would ring true with a lot of these cost segs and bonus depreciation. Of course, we have the overhead expenses, which can be power, electricity, property taxes, what have you. All that aside, now we get into this thing called QBI, qualified business income. And what QBI is, it's something for us as individuals, or if we have an S corporation or a partnership, does not apply to our C corporations. And basically, it says that you can take up to 20% deduction if you have a business that is profitable. That's the real key. Now, again, it's the US tax code. It's not always that simple. There's a lot of calculations that can go into a QBI, but we're going to really simplify it and just keep it at, you get a 20% deduction. So if you had $100 of income, it qualified as qualified business income, you'd be able to deduct $20 or 20%. So now your taxable income is only $80 in my simple example there. So now moving forward in our question, we're asking, can I do this special qualified business income deduction on that $20 of profit? I got 3 rentals, each of them making $20,000 of income. But what we're not thinking about, we just want to know if we can take the QBI deduction against that. Well, we can't. We have to take in the 60,000 loss that's associated with each of those buildings. So if each makes $20,000 times 3, and each has 60,000 of loss, you're going to have 3 buildings with $40,000 of loss, and we don't take QBI against the loss. So no, QBI would not be available here.
Dang.
That's a lot. I hope I didn't lose you too much.
I got to just to reiterate. So, I'm just going to paraphrase some of what you just went over. When you have rental property, the typical way it's treated is passive activity. So a typical rental. What's not a rental is when you're using an Airbnb or a VBR where the average stay is 7 days or less. And the way you do it is you say the total number of days it was rented. So if you did it for 200 days, divided by the number of unique rentals. So if you had 30 unique rentals and you rented it for 200 days, you're going to be somewhere below 7 days or less. You'll be 6 point something. So that is not a passive activity anymore. That is a trader business. And my favorite example of a trader business is
Pizza time.
Pizza shop. We are a pizza shop at that point. And just like in the pizza shop, we might have ovens, we may have stuff that we want to depreciate, which means deduct. So now we have these structures, the houses, and we could deduct them. And generally speaking, on a short-term rental, it's 39 years. Residential, you're going to say, wait a second, it's 27 and a half. When it's a hotel, which is what this is considered, it's not a rental activity anymore. It's a business. It's 39 years. But we could break it into its components. And so you correctly pointed out, like carpet, that's 5-year property. You don't write it, carpet's not going to make it 39 years. The improvements that you put outside, like planted some new trees, you put in a new driveway, put in a walkway, put in a fence, none of that's going to make it 39 years. That's 15-year property. And then you can accelerate that. You could take 60% bonus of that amount in this year, unless you put it into service in a previous year, in which case you could go up to 100%. It's a fancy way of saying you get a big deduction. That's all it is. So when Professor One has 3 short-term rentals, think of it like this. They have 3 pizza shops. Each one, before you take the expenses, is making about 20 grand gross profit. But then they have all these other things they can write off as a deduction. And it's going to make each one, what is it?
$40,000.
$40,000 each. So each pizza shop is losing $40,000 each. That's the easiest way to look at it. So that's a $120,000 loss. Now, this is where it gets fun. That could still be passive. So if Elliot and I start a pizza shop and Elliot works in the pizza shop, right?
Used to do that.
Yep. But I don't.
Pizza.
I'm looking at Elliot going, I'm not going to flip a pie. I'm passive. I don't materially participate. Elliot materially participates. Same business. Let's say it kicked out losses to both of us. Elliot's is ordinary. He could use it to offset any other income he has, non-passive, because he's a material participant. Me, if I'm in the pizza shop and I didn't materially participate, it's still passive. Passive losses can only offset passive income, with a couple of exceptions: active participation and real estate professional. So when we look at these, we're first trying to say, is this a business or is this rental? Because there's different rules. This is a business. They're creating big losses. Fantastic. The only question I would have here is that $40,000 loss non-passive or is it passive? And if it's non-passive, do we have other income to offset, like W-2 income? If this is a professor, then probably going to offset their income, which means more money in their pocket, which is great. I hope that they're doing a little bit of calculation and saying, is it worth it? Like I tend to not do a whole bunch underneath 200 grand. Like if I get someone to 200 grand, like they're $400,000, we get them down to 200, it's usually good. Like we're not paying an inordinate amount of taxes. Where it really gets bad is when you get up into the highest brackets, right? But I don't want to offset 12% income with deductions. But it's up to you. You get to make that decision yourself. Is the juice worth the squeeze? So here, QBI is not an issue because there's not going to be profit out of these entities. These are all going to be creating net losses. And those losses, shoot, if you're materially participating, and chances are, if they're working in them, they're going to be able to meet one of their 7 tests. The easiest one is you do everything. The second easiest one is other people help you do work on those short-term rentals, but you do 100 hours and it's more than anybody else. Those are the easiest ones. And that's for the year. And that's a husband and wife combined, or, 2 spouses combined. So what a big, huge benefit. Like these guys are sitting on a tax gold mine, which is absolutely fantastic. Really these questions from these guys.
Yeah, they brought it.
Just stellar, right? So like we could probably spend the entire day going over just the concepts that are there. Professor 2 has 4 long-term rentals. So now we know that there's trader business like Airbnb and other types of just rental. And so when you see long-term rental, that means it's not short-term. It means it's passive rental activity. And they used line depreciation, meaning I didn't accelerate it, right? I'm going to write off the carpet over 27 and a half years, since this is a long-term rental and residential. His wife is rep, but there are not enough losses to offset his $300,000 of income. His CPA suggests putting 200K in a syndication as an LP. K1 will generate $150,000 of losses as long as his wife is rep, real estate professional status. He can use those passive losses to offset his W-2. Is that true?
It could be. In this case, if we have rep status and now we've introduced the syndication in here, we got to ask, how did we get to rep status and real estate professional status? And that test is a little bit more involved. This individual, the spouse, has put in over 750 hours in a real estate trader business that she materially participates in. It's over 50% of her work hours throughout the year. And she's will have had to materially participate in the management of their rental properties. And that's where, as long as she's doing that, and I'm sorry, and to get that material participation, the test that Toby was talking about earlier, he talked about the over 100 hours and more than anybody else. There's also the 500-hour test. And because we're introducing a syndication, and this is a limited partner, that's the LP here at K1, we're going to have to meet that test, the 500-hour test. So in other words, to get our rep status, if we didn't use the 500-hour test, we may not be able to do that. That's why I say it depends. But if we did get 500 hours to meet our material participation test, and we aggregated, which we pulled them all in, it's an election you make to get your rep status. And I'm going to suggest they probably did when they have 4 rentals, start getting a lot. In that case, then yes, it will pull in that loss from the syndication. 200,000 will become a loss against the income. That's correct.
There's a big difference between limited partnership syndications and LLC syndications. When you're a limited partner, it removes all the other, well, there's 2 tests that you can meet for LP. One of them is the 500 hours, and the other one is what, a 5 out of 10 year?
Yes, the historical.
Right. So there's 7 tests for material participation. And if you're an LP, not a GP, but an LP. So one of the ways you get around it is by being a GP. If you're an investor, sometimes the syndicator will let you have GP units. Syndication is a fancy way of saying a group of investors together. So a syndication is like an LLC that's buying an apartment complex, and I, under Reg D of securities, is allowing people to invest with me and then put money into that LLC in exchange for ownership in that LLC. So they're owning a piece of the LLC. In this case, it says LP, so they own a piece of the limited partnership, and they're a limited partner, which means they have no management rights whatsoever. And then when they do that, then there's a regulation, it's called the regs, under 469 that says, aha, if that's your case, unless you're a GP or you spend 500 hours as in material participation, that's going to be passive. I think there's another solution, by the way. So hopefully this professor's on, because this is what I'm going to suggest you do. If you don't have enough losses, then, and you did straight line, then look at doing a cost segregation and unlocking more depreciation now, and it'll wipe out some of that income. You may not even have to do the syndication. If you feel like, oh gosh, the syndication isn't something I necessarily want to do, then you might look at other investments that create non-passive losses. Oil and gas is a great one. Other things you could do to offset your income is short-term rental, right? We don't have to worry about real estate professional, but you have an appetite for that. Like, I'd probably look at acquiring additional long-term rentals. Even if I was going to do a short-term rental, I may do it like this. I may buy the property and lease it to a corporation that is the host so that I can keep it as a long-term rental and group it with my other long-term rentals if I'm a real estate professional. Otherwise, it's considered a pizza shop.
Pizza,
The
pizza.
short term would not be allocated, it would not be aggregated with the 4 long-term rentals. So with a little bit of knowledge, like you could do some great things here. Like, my guess is that you actually have a couple of options. Number one would be the lowest lying fruit is just to change your accounting method and get a cost seg. The second level is do the investment in a syndication as an LLC rather than an LP and not have to worry about the 500 hours. Third is, if you really like that LP investment, do that. And when it creates its loss by doing cost segregation and bonus depreciation, I guarantee you that's where that loss is coming from, then it'll offset your other income. And yeah, $150,000 loss against 300K of income cuts your tax bill by more than 60%. Fantastic. Great job. And what should I do? Like, oh, that's
Rick?
yeah. I was thinking maybe there was something cool. I
Well, we
hate
got
this.
Rick.
I can't do this. I can't do it. Oh, wait. Yeah, you're
you
kind
go.
of a
Bad to the bone.
bad. Yes. All right. Let's move on. Professor 3. We should all go to Iowa State.
Iowa State.
Iowa State. Ohio. Iowa State, because you guys are smart. But engineers are always super smart. Like engineers, invariably. You guys are always the ones that send me my book back with like 3 edits. You missed this, Toby. Always an engineer. It's never the English major.
No.
All right, Professor, sorry, English majors. We love you too. But engineers, holy crap. All right, Professor 3 has 1 passive long-term rental and just bought 2 short-term rentals with 7 days or less with cost sag plus bonus depreciation. So now you guys know this language, right? You're looking at it going, oh, this is a long-term, which is real estate, and he bought a couple of pizza shops, right?
Pizza.
So we have 2 pizza shops, 7 days or less, and he's writing off the houses much faster. Next year, 2025, his wife plans to retire and claim real estate professional status. The plan is to keep those 2 short-term rentals as Airbnb, but with 8 days or more, AKA passive. All right. Can I just stop real quick? Because we'll go through this question, then I'll let you answer. There's actually 3 other ways that it could actually be a business. It's not just 7 days or less, that's automatic, but 8 days to 30 days with significant participation. You could also be, or then you could have substantial, I think it's extraordinary participation, 30 days or greater. So like if you're doing a rehab clinic and it's not a rental activity, but just because it's 8 days or more, it depends on what services you're providing with it as to whether it would be passive. Just to say that, I just wanted to get that out of my head before I forgot. The plan is to keep those short-term rentals as Airbnb, but with 8 days or more, and keep the long-term rental as is. The first question is, can the wife manage clean those 2 Airbnbs and claim the 750 hours without touching the 3rd long-term rental that is far away from the group altogether? The second question is whether we can use the losses from the cost seg we conducted on those 2 short-term rentals this year. The confusion comes from the fact the math was divided by 39 years and now both are 27.5 years.
All right. So just starting off with the first question is, can the wife manage the 2 Airbnbs? And remember, we're talking next year when the spouse is attempting to get that real estate professional status. And remember, real estate professional status refers to long-term rentals. Okay. So can the spouse manage these short-term rentals and add those hours towards the tests required for real estate professional status? I'm going to say no, because remember, a short-term rental isn't rental activity. It's the pizza shop, okay, that Toby keeps talking about. But if they're managing a long-term rental, well, yes, those hours would go. However, we do have a fix for that. Toby talked about it earlier. Why don't you set up maybe a C corporation? You rent the short-term rentals long-term, a year, to your C corporation, and then you conduct the short-term activity. You sublease it from the C corporation. That makes your short-term rentals now long-term rentals. And as we talked about before, you can aggregate or pull all your long-term rentals together. And now the spouse can manage those rentals through the C corporation. That will count towards our hours. So by just making a slight twist, yes, we are able to get there for question number 1. And yes, we would aggregate. I don't want to use the term group. That actually has a different meaning in the code. Excuse me, with material participation, but here we're going to aggregate them together. Second question, can we still use the losses from the cost seg we conducted on those short-term rentals in 24, I'm assuming? The confusion comes the fact that the math was divided by 39 and now are both 27. So really the confusion doesn't have anything to do with the answer here. The second question, can we use those losses? If we incurred them in 24, and if they were passive losses, then they're going to stay passive into the future. We're never going to change them. They keep their identity. if these were in the short-term rentals and we materially participated and they were non-passive losses, well, they would probably be used this year. But if there was any carryover, they would continue to be ordinary non-passive losses. So in that sense, you wouldn't have to worry about anything. The idea that we're going from 39 to 27, what that has to do with is that we were a short-term rental and we divide by 39 years to get our straight line depreciation. Now we turn it into rental, which is actually 27 and a half years for long-term rentals. To do that, what you're going to just as a kind of a bonus here for anybody who wants to learn this, we're going to take what's called the adjusted basis at the end of whenever we made this conversion from short-term to long-term. Short-term was under 39-year straight line depreciation. We now, let's just say we did it at year end. And so January 1st of 25, it's now a long-term. We're going to divide that adjusted basis. That is whatever has not been depreciated yet. We're going to divide that amount by 27 and a half years and continue on. The code does give you a provision though. If you're going from 39 years down to 27, you do have the option to retain your original 39 year depreciation life. So that's a little bit of a special thing going on there. But to get back to the two main questions, can we do the 750 hours? Not without that master lease. We're going to need to have that master lease, turn those short terms into long term. And then yes, our activity of managing those will count towards 750 hours to get that rep status. And then second, can we still use the losses? If they've already been incurred, we took the studies, we incurred it, and they were passive in 24, they will retain being passive and follow those passive loss rules. So they very well might not help us for some time in the future. If they're from the short-term rentals and we materially participated and they were already ordinary losses, they will have been taken in 24. If there was too many losses, they will continue as an ordinary loss, net operating loss going into 25.
You're killing me, Smalls.
That was a lot. That was.
Oh my God.
Right?
Okay, I do have one issue with something you said.
Hmm?
If they manage the Airbnbs, I believe that would work for the 750 hours, but it wouldn't work for material participation on it because it wouldn't be considered a rental activity.
It could be. I just have never found it. We've actually asked this and looked at this a couple of times out there in amongst ourselves here. And I never found the actual answer. So I honestly don't know.
I do. I know.
Well,
this.
he knows it.
Yeah, for 100%.
Okay.
Because you could take multiple trades or businesses and grab that management towards it. So if you're managing an Airbnb, that's no different than real estate activity of managing anybody else's activity, and the IRS has held that you can count that. It's just not towards your properties. Usually you grab those and count them if you're management, and you count the hours towards the 750. And then if it's self-managed, you count those towards your material participation on yours as well. Here, you can't count the material participation hours, but you could count the 750 hours. So like, but it sounds like she's a real estate professional anyway.
Anyway, yeah.
Yeah, so I'm not too worried about it.
Mhm.
And then you don't have to do the cost seg. So if you did have a loss, you could wait until next year actually to do the cost seg.
Yeah, you could have had the study done and just hold off and then use it this year.
Yeah, we could claim it at any time. So
Yep.
like let's say I put a property into service in 2020. And you're looking at your 2023 taxes, and we're coming up upon the deadlines, right? And you're like, shoot, I really wish I could get some of the money I paid last year back. 2024 hasn't been what I really expected, or I could just really use that cash. You could actually make an election for your 2023 taxes to choose to take your cost segregation and change your accounting all the way up until you file the tax return, either the partnership, or if it's going straight on your return, October 15th, you could make that election. The year that you use for determining whether it's 100% bonus depreciation is the year that it was put into service, which under this, my example was 2020, which would give you 100% bonus depreciation. So you grab it all and you get yourself a big fat loss. So here, they could wait. You could wait. And it'd be interesting to see and play around with it a little bit, but I get what you're saying.
They'd be fun calcs.
Yeah.
They're really for us.
Yeah. We like to play different scenarios, and that's actually pretty cool.
Yeah.
Anyway, that's the first three.
Yeah, they get easier.
Wow. We're gonna be here till midnight. I have a question about capital gains tax. I'm selling a property with an installment payment plan, only 2 installments to be received. The first payment will be received in December 2024. The second and last payment will be received in January of 2025. How will this affect my capital gains tax? What do you think?
Well, simplistically, it's just going to split them. You're going to, assuming that you have equal payments, what's really going to happen is you're going to have your gross profit percentage. You take the amount of profit, let's just say you sold it for 100,000, your basis was 60, so you gain 40,000 is your profit. You divide that 40 profit by the original sales price, 100, that gives us 40%. And then you take whatever amount you received in installment 1 times 40%, whatever amount you received in installment 2 times 40%. And then typically that will be the amount of gain that you will recognize, 40% of that amount each year. Now, Toby brought up a really good point before we started here about this question. What if it had been a rental and you had some depreciation, or it was an asset that had depreciation? You're going to have some depreciation recapture, and you must handle that first, pay that in the first year. So we will have that contingency here as well. But that aside, the simplistic answer is that, let's say there were equal payments, the first and second payment, you'd take it times, in my example, 40%. That's the amount of gain you'll recognize in each year. And what you've done here is been able to streamline your income, so you're not in a higher tax bracket overall, typically. So it's good plan.
And you should know that it's this code section is 26 USC 453. You could choose to elect out of it. So like if this year you're going to be in a lower tax bracket the next year, and you're just doing this because the other party doesn't have the money and you'd rather have it all taxable in this year, you could, if you close this year, you could tax it this year. You can elect out of the installment and then have it all taxed this year if it's going to be better for you.
Yeah.
It all depends. Sometimes long-term capital gains, if you're married filing jointly and you're less than $94,000, you're at 0%. And then anything up to about $500,000 is in the 15%. You may be looking at it going, shoot, I have a bunch of 0% that I want to use up. You might be able to use it even with the 2 installments, but it's up to you as to whether you choose to spread it out over the 2 tax periods or not. You should know that. We do this also when we sell homes that have a 121 exclusion. Sometimes we opt out of the installment sale and have it taxable all in the 1 year because you have no capital gains. And even if you're carrying back a note, it makes it a lot easier for your accountant. Plus, you're not paying tax on it. You're just grabbing it all right now. But yeah, well put. Good one.
Yeah, next one's just building off of that.
Okay, paying tax on real estate long-term capital gain. If my net income is under 93,000 in 2024, well, I owe taxes on long-term capital gains from the sale of real estate, vacation rental. The gain itself is over 93,000.
So yeah, this is really just, I threw this in there because it's an extension of what we just went over in the previous question. Excuse me. As Toby pointed out, if you are below approximately 94,000 in 2024 in total income, your total taxable income, that's all your ordinary income, your interest, income that you've had, capital gains, etc. If it's below 94,000 approximately, then any capital gains that you have, it's going to be taxed at 0. And I think that's what we're trying to get at here, is if we're below approximately 93,000, approximately that 94 amount, is there some way we could get in there and have 0 on here? The problem here is whether or not that gain of 93 is being contemplated in the total income of the 93, the net income of 93. If it's not, and a lot of people do this, well, my ordinary income was 93,000. My net income, Elliot, from all my work was 93,000. And so I'm below the amount 94, and I have this 93,000 capital gains. So I can get that at 0, right? No, that's incorrect. You have to add the capital gains on top of your ordinary. So here we would have 93 plus 93. That's going to give us 186, and we're well above the 94 0. So we're not going to get most of that at 0. It's going to be largely at 15%.
And it's also the 93 it's closer to 94,000 for married filing jointly. You're about half of that if you're single.
Yep.
So, look at it, but it does get added. I remember I had this with a client who thought that, hey, I'm going to keep my income below this, so I never have to pay capital gains. And it's like, it doesn't work that way.
Yeah.
They got really mad when you didn't. And I was like, I don't write the law, but
I was beat up on the messenger.
yeah, I try to follow it. But I below this. Yeah. No, it's not zero. You can't have $1 million capital gains at zero. You can borrow.
Yeah.
That works. Don't sell it or 1031 exchange it and borrow against it. Lever it up. Go for it. Next one. How do I reduce my tax liability as a flipper?
First thing you just,
It's a
you
dolphin?
right? Exactly. That's what I
That's
was.
what I immediately started thinking about.
I did too.
Remember
actually.
Flipper?
Right?
Those were great. I always wanted to like have a boat and jump off it.
There's those Jim Carrey with Snowflake. I remember Snowflake that also in Flipper. Anyway, the first thing we're going to suggest here, or at least I am, is you do it in a corporation. There's besides just immediate tax deductions and things like that, we want to avoid dealer status. You don't want to be flipping a lot in what I'll call your personal name, directly hitting you. If you get hit with dealer status, there's a lot of negativity to that. And so we were going to recommend, or I'm going to recommend doing it in a C corporation first, maybe an S-Corp. Kind of depends on what your goals are. But the idea of doing it there in the corporation, number one, it will prevent you from hitting that dealer status. So there's protection of that. Number two, both C or S corporation, or this includes LLCs, taxed as S or C. You're going to have things like the corporate meetings that you can do at your home that we talk a lot about under Section 280A. You can have an accountable plan, which just means reimbursement for maybe an administrative office in your house. So both of those are going to give you lots of opportunities to get a lot of cash back to you tax-free. That's going to be a deduction against any income you had originally from your tax liability. So that's why I'm going to recommend a corporation, again, S or C. Toby had some really good insight, and I'll let him handle that as far as S versus C, which you would pick. So
Okay. There's a question that's actually going on in chat that I was
Ooh,
also paying attention to. So I'm just going to say, hey, Patty, get Robert with somebody. Robert, when you have a self-directed IRA that you're doing syndications in, you have unrelated debt finance income. If that syndication has loans against it, you do not have that if you roll that into a 401k. So if we can avoid that little tax hit on you, it might be good. And one of our accountants will explain how that works. But UDFI is for IRAs only, not for 401ks. So sometimes you could take a self-directed IRA, roll it into a 401k, and avoid that tax, and it could save you thousands of dollars. So it might be worth doing if you're doing a syndication. I assume it's not small. Okay, so Flipper, they're sitting there doing their an active trader business. They're a
Pizza.
Yep, they're a pizza shop. So what do we use for pizza shops? Same thing that we'd use for any major business. We're going to write everything off we can. We're going to use an accountable plan. We're going to be a corporation of some kind, an S or a C. And then the question is, do we want the money to flow onto our return, or do we want to keep it separate? And that's going to be a question of what other income do you have as an individual? So like if I am in the highest tax bracket through my job, I may want to just keep my flipper income in a C-Corp and have it taxed at 21% as opposed to 37% plus my state. I may be saying, hey, I want to just keep building that up over there and letting it grow and grow and grow so I can do my flips without hard money, or maybe I can loan it out, money from that corporation to my other entities to create liens against those properties, et cetera, and start to build it up its value. There's a misconception out there about taxation of retained earnings. But if you have a reasonable need for the cash, you can have as much cash as you want. Like look at Warren Buffett in Berkshire Hathaway. They got like 200 billion and or
never
God
pays a dividend.
yeah, probably more. The same thing with Apple and Microsoft, all because they always keep money on hand because they might want to do acquisitions. You just have to say, hey, I might want to keep money on hand so I can do acquisitions. The only thing I would say to you is if you're flipping, is create sub LLCs to do the actual flip. So if you are flipping multiple properties, you do not want a bad flip that happened 2 years ago to ruin your day tomorrow, right? You don't want it to come back and haunt you. And so what we suggest people do is use LLCs for each flip, and then when it's done, you dissolve it, and then your liability goes bye-bye with it. So that if somebody comes along in 2 or 3 years and tries to go after anybody that was in chain of title, you can avoid that. Or if they try to say you were supposed to do something that you didn't do, you could say, okay, go ahead and sue the dead entity. See where that gets you. It's not going to get you anywhere. As far as things that you could do to reduce liability on an active trader business, I like 401ks. I like defined benefit plans. If you need to put more than $100,000 a year away, a defined benefit plan is great. We had I work with Jeff Mason over at Redwood, and it was really interesting. He had a client that did a defined benefit plan, and they put $1.2 million away last year. Yes, you can do that. It's all based on the actuarial tables. That's what Jeff is. Done some videos with him. He's on my YouTube channel. So if you look for any of the retirement plans, it's usually the 100,000 plus retirement plan. That's going to be on cash balance plans, defined benefits. You have to work with a licensed actuary. That's what Jeff is. That's why I always bring him on, because he's the number cruncher, not somebody promoting a financial product. But that would also reduce your liability. Writing everything off that you can, that's 162 deduction, all ordinary necessary deductions, plus bringing your family onto the board, paying for their expenses, possibly doing a side business or managing your other entities. All that can be integrated into this as well, if there's an appetite for it. So we'd like to take a look and see what stuff's coming out of your pocket, because something as innocuous as this, like one of these, a little cell phone, right? If I'm paying for that out of my pocket, that company could be reimbursing 100% of it if I'm considered an employee of it. And even though I've already paid, like, you're already paying for it, it might be, $2,000 or $3,000 a year that you can immediately deduct. Okay, that starts to add up. It's usually right around what, 20 grand that we find between 280A, administrative office in the home, cell phones, technology, cars, mileage, all those things. When you start adding them up, it's usually right around 20 grand that you're already paying. So the tax savings on that depends on your tax bracket. If you're a normal person, Tax Foundation says the average is about 29% tax between employment taxes and income taxes. So at a minimum, it's about $6,000 a year that would save you. And there's, if you have to do an extra return, so it costs you, $1,000, $1,500, $2,000 a year, whatever it is to run it, then you're getting 3 times your money. So like it's the old question, is the juice worth the squeeze? And you can start doing that calculation. And then Elliot and his team all day long, they do these with something we call Tax Saver Pro, where they're running scenarios, returns through computer software, and they're analyzing it and crunching the numbers, looking to see how much they can save people. So like if you're ever curious, then you could talk to somebody about Tax Saver Pro, and they're sitting there running the scenarios, and your guys' average right now,
It's up there.
it's about $47,000 a year in federal, and it was about $7,000 a year in state. That's the average that they're finding in missed deductions. And a lot of times it's things like retirement plans. It's doing things like HSAs. It's putting monies aside in a tax deferred account, or writing things off that you're not already, like you already have an expense, and let's just find a way to deduct it on something else. All that stuff works. Long answer to a short question.
Yep.
Reverse exchange 1031. Please help us understand it. How do I choose a QI? Any recommendations for first-time 1031 exchangers? Thank you very much.
Right. So reverse 1031, well, it's the opposite of a 1031, which we probably want to define that. 1031, the idea is I've had a property that's in a trader business. It's got to be real estate, my property, and I want to sell it, but I don't want to pay tax. If I do sell it under 1031 rules, and I acquire replacement property that's basically kind of the rule of thumb, more expensive than what I gave up, and I pick up more debt on that new property than what I gave up, then I don't have to pay any tax, and I don't have to do depreciation recapture. It doesn't mean that won't stay along. It still totes along until I sell, but as long as I didn't have any gain, I'm not going to incur any of those things. That's a regular 1031. Reverse, all you're doing there is you're first buying the replacement property, and then you're deciding within 45 days which property you're going to give up. And so it's just the opposite direction.
You have 108 days total
100, yep.
from close to close to get rid of that property, to sell it.
Yep. That's your 1031. The reverse just means you're picking up first and then selling, as opposed to selling and then picking up. It's just a difference in the order.
Yeah, and the only recommendation that I have is be careful. You don't want to tell people on 1031 exchanging necessarily, because they might figure it out, but you don't want to go out there saying, I'm looking for a 1031 exchange, because there's people that will mess with you a little bit to try to squeeze you.
Yeah.
Knowing that
There's a
you could
ton.
lose tax liability, they may start jacking around with the price, saying, I think we really need a discount, or we're going to delay this, and you're going to miss your 180-day window, right? They do things like that. So just be careful with it. If you're finding someone that where you're looking for replacement properties, you want to line them up, I have no problem with that. But when you're going out to the general public, you don't want to, accidentally get somebody that's going to hurt you in any particular way. And we'll just work with somebody that's a QI that's done it before. There's a lot of folks that magically hang out a shingle and say, I'm a 1031 exchange qualified intermediary. You want to work with somebody who's probably done at least 100 of them. You just interview, see who you like. Speaking of people who we like, there's Clint. Feel free to join us for a free tax and asset protection workshop. It looks like there's one coming up this weekend and the following weekend. And then we have live events September 28th through the 26th through the 28th in San Diego. And then we have another one here in Las Vegas in December. Those are the fun ones, guys. It's just fun to hang out. And they're pretty inexpensive too. So they got it. Hey, Kareem, are you rolling around out there? I just heard that Kareem's out here.
Yeah, I'm here.
There he is.
Oh, where are you?
Oh, he's in the other.
See
across the
me?
hall.
I'm
Oh
right
my
next
God.
to you, Toby. I'm sitting right next to you.
You're like in another, like you're in studio.
Okay. All right. Yeah, I'm in the other room. I'm in the studio.
You realize that it doesn't matter that you're here physically now because you're on a camera. Like we could do this whether you're in North Carolina or in Las Vegas.
Yeah, I realize that, but I'm usually booked up about that time when Tax Tuesday's rolling around.
So I just have to let you know, this is my chance to use my new button.
All right. Not the eject button.
That's my new favorite button. That's for John.
You scared him.
I'm sorry, guys. Your cat just jumped. Buckle up. All right. So what brings you out to Las Vegas, Kareem?
Well, I'm here to shoot some videos. We're doing videos for these new modules that we're creating for nonprofit organizations. So it's going to help organizations kind of come up with sort of from startup to success. We're going to provide resources and content, articles, videos to help organizations. So from setting up the organization to effective board meetings, to writing effective emails, to grant writing and grant applications. So we're going through these videos to create content and resources for our nonprofit organizations. And in addition to that, we're also going to do a workshop, which is going to be on Thursday. We're going to be doing start and run a nonprofit, and we'll be going over the many types of nonprofit organizations you can set
Is
up.
that an all-day workshop?
It'll be 4 hours. It's from 9 a.m. to 1 p.m. on Pacific.
Nice. And I think
And on the
Patty-
East Coast, it's from 12 to 4. Yeah.
All right. So you should definitely join Kareem. And who's going to be teaching it with you? Just you?
I'll be doing, Wendy will be presenting, and so will Savannah Wallace as well. 3 of us.
They used to.
It's going to be
invite-
great. A lot of content, a lot of resources, a lot of information out there. You're going to learn a lot. You're going to be inspired. You're going to be motivated. You're going to want to set up a nonprofit.
They used to invite me to those and let me speak at them.
Yeah, what's up with that, Kareem? Not that I'm trying to throw you under the bus or anything.
Look, he's always invited. He just
You are fake
conveniently
news.
has a conflict
You
at
are
that
fake
time.
news. You are fake news.
Never invite.
You are fake news.
Never. Never.
Yeah.
Absolutely. Free access. Yeah, no, it's free access. You guys can come in and learn about nonprofits. We love our nonprofits. We actually sometimes like Kareem. No, we love Kareem. He does a great
That's not
job.
true.
Everybody loves Kareem. The whole division over there. If you've ever wanted to figure out whether there's something you could do that's help society and also get a bunch of tax benefits, they go like this.
Yep.
They do really nice things together. So Kareem and his team are the ones to check it out, and you can invite more people to watch. Absolutely, as many people as you want. And believe me, like this is one of those weird areas where, especially as you have success, it's where everybody ends up going. It's like, all right, now I'm not so worried about me anymore. How am I going to create my legacy? And those nonprofits are really great vehicles for your family to actually get together and carry on something that you think is really important. And it's, there's always some goofy nonprofits out there that we point out, like IKEA. Rolex is actually owned by a nonprofit. The Green Bay Packers is a nonprofit. Like there's some funky ones. Major League Baseball, NFL was, but it's always interesting when you start diving in, saying, "What is actually a nonprofit? What could I do?" It's always cool. Preem, anything else?
No, bring as many people as you want. It's free. The content is free. The education is free. So come one, come hundreds, bring everyone. They're all invited. They're all welcome. And just a word of warning is that you're going to get some bad dad jokes. I'm going to sing. I'm going to sing some 80s songs probably. So you're going to be entertained.
I don't know if we should be
we
scared.
salute that or not.
Yeah.
Oh, come
I-
on, Toby. We're like the three tax amigos, the three of us. We're like, we make tax less taxing. Huh? Yeah. We're like tax experts. Huh? Come on. Yeah. What do you think?
All right, enough of you. How do we cancel Preem's feed? No, just kidding.
Can't undo it. Sorry, Toby.
All right. Thank you, brother.
All
Appreciate
right.
it.
Thank you.
All right. Is it possible? I think did we skip one? No, there we go. All right. Is it possible to use solar credits against passive income from real estate rental income?
Yes. You can have a solar credit. You could do it on your personal home, which would create an ordinary loss. And that's going to offset any income on your return. But what if you put a solar on your rental? Yeah, that's going to offset against that. It's going to be a passive deduction, but yes, it will offset passive income.
Yes. Here's the one thing is if you ever go and you're doing solar, for example, on your rental properties and it's passive activity, then it stays passive as a solar credit. But if you get an individual solar credit, you use those against anything. So just know that the nature of the activity that the solar is attached to might have something to do with its tax treatment. So I don't want anybody to get out there, have a bunch of solar credits on a bunch of rentals they have, and then be disappointed that they can't use it on everything. But if you're doing it individually and you're entitled to that tax credit against your individual tax, it's ordinary, non-passive. You don't have to worry about it. All right. How do you determine if a repair in a rental property can be treated as an expense in the current year or must be depreciated?
So there's a couple different ways to look at this, but generally speaking, a repair is you're just fixing something that just got, maybe it wasn't broke last week. Maybe a window got busted. So you're just fixing it, doing a quick fix or something like that. That's usually your repair. You brought it back to how it was before it got broken. Example of something that needs to be capitalized or that's going to be depreciated will typically be you have a situation. The example I often give clients is you call me over to fix some stairs. And I fix them and they're going to be okay. They're going to get by. But I realize there's a lot of wear and tear. They've really kind of broken down over the years. And so I bring a lot more to shore it up and, and recreate almost the stairs. That's going to take on the flavor of being something that's a capitalization, which means we're going to have to depreciate. Those are kind of the two, opposite ends of the spectrum. There are things such as if it's under $2,500, we may not care. There's what's called a $2,500 de minimis election where you can automatically deduct each invoice. So in other words, window one breaks, if it's under $2,500, I can certainly expense that. Window two or something else, the curtains break or whatever, if it's under $2,500, that's a separate invoice, I can expense it. So there's those little offsets on this rule as well.
If you are keeping financials that are not related to tax, that actually doubles that amount to $5,000 per invoice, but it is per unit. Like you can't, hey, I have a whole bunch of air conditioning units. I can't just fix each one for $2,500. They're going to lump those puppies together. But for most everything, you're just in the safe harbor at $2,500 or below. And then for anything else, it's common sense. If you're making the property more valuable by doing it, like you're doing a remodel and you redo the kitchen That's not a repair. You're making it more valuable. You replace the roof. Here's the thing, there is a way to get a big tax deduction out of that, and that is by retiring the old roof. But you're gonna have to figure out what portion of the property you're able to deduct. So if I have a roof that was 20%, the way you do this is you look at the repair value of the entire house, replacement values of everything, and said, hey, if I was to replace it, I'm gonna get a new roof. Let's say it was $20,000 and the house is 200,000 to replace, then it's 10%. Then you go back to your original purchase price. Let's say it was 150, your roof is $15,000, figure out the depreciation you've already taken. Whatever amount you haven't taken, you released as an ordinary loss or non-passive loss. So there's lots of fun things that you get to do with this. Just know that you're not always out. Like, it's not always oh shoot, I can't write it off as a repair. It doesn't mean you're toast. It means that we may have to take a look and do another analysis to see whether we can create a better deduction. And then you always have cost segregation in your back pocket. There is one other thing, which is if you plan on, if you're going to have to repair it or replace it 3 times out of 10 years, then you can treat it as a repair. If it's something that's always doing. Saying somebody says if you are replacing carpet due to water damage, can you deduct it immediately?
Yeah, I would think so. Yeah, certainly.
If it honestly depends. With carpet, usually you plan on replacing it 3 times or more in 10 years. Otherwise, it's 27.5 years. So you would take a deduction for the depreciable value of that carpet that you haven't taken and subtract off any depreciation. That would be a little something, that would be something different, right? So, but regardless, there's a good chance that you're going to be writing off a big chunk of that. And then if you really needed to, you would just cost seg it and write it all off. Somebody says, what about resurfacing a pool due to a leak? Yeah, you're fixing the pool. So you're fixing it. You're okay. My husband and I want to sell a new construction home business to become full-time investors and manage our 5 commercial. I think is the last one, right?
Yes.
We're a little bit over. Hang out with us, guys. My husband and I want to sell a new construction home business to become full-time investors and manage our 5 large commercial properties. In the past, we have had real estate professional status because we self-managed our commercial properties. I don't know why that would change really, but let's just keep going. If we sell our construction business, do you still qualify for rep status if we start a management company to manage our rental properties and earn W-2 income from this new company? What time of entity would be best? So probably what type of entity would be best to set up for a management company? LLC, S-Corp, or C-Corp?
So yeah, once we have rep status, we probably still have it going forward. We're putting over 750 hours. It's over 50% of our work week. We're materially participating. Probably the 500 hours, I'm sure, is probably a foregone conclusion with that many properties being large commercial. So yeah, I don't know why. I'm with Toby. I don't know why the rep status would change. You certainly set up a C corporation, manage through that. That's just going to give you added tax benefits. And using that management company that you own yourself, certainly you can use that towards your time.
Yeah, the only thing I could think of is that they were doing a construction business, and that's where they were getting their 750 hours. And the self-managed didn't amount to that amount of time. So you have a couple of different ways that you might be able to qualify for this. You're going to have to do the 750 hours, but you can count the time that you self-manage. And self-manage means you or an entity that you're greater than 5% owner of. So if I'm setting up a management company, I'm probably doing an LLC tax as a C-Corp just as a starting point. And then I can make an election later. There's no reason not to. And I can count that time towards my 750 hours and my material participation, both of them, because they're my properties. So you could, if you can hit the 750 hours, you'll be fine. If you can't, and we don't have the 750 hours, then yeah, you're going to have a little bit of a trouble. You're going to have trouble. You can't do the 750 hours to try to hit the 750 hours. There's a funky little rule that says if the reason you're doing the time is to hit the 750 hours, it doesn't count. So like dumb. They put a threshold and they said, if you're trying to hit that threshold, it doesn't count.
By the
Like,
way.
yeah, it's just they're looking at you saying, hey, would you do the 750 hours regardless? Is what they're really saying. I always find that a little bit maddening. I don't know how they know. I would just say no. It's crazy. But your self-management counts for both the tests. And if you're not familiar with real estate professional status, it's a fancy way of saying normally you have passive loss that you can only use against passive income. With real estate professional, it becomes non-passive loss that you can use against any other type of income you have, including your W-2. So real estate professional is great if you have big depreciation and you have losses. The way to hit real estate professional status is to do 750 hours, and there's about 10 different trades of businesses: construction, development, management, being a real estate agent, all those types of things qualify. And you have to do 750 hours, one spouse, 750 hours in a year. And it's more than 50% of your personal service time. So if you do 750 hours as in real estate and you did 1,000 hours as a chef, you don't qualify because it has to be more than 50% of your time. But if you did 1,000 hours in real estate and 750 hours as a chef, you would qualify. Right. So there's that. And that's test number one. Test number two is, did you materially participate on your rental properties? So here we have 5 large commercial properties. Okay. So those are your rental properties. You have to materially participate on those. You group them as one activity. And then did you meet the first prong? So it sounds like they may have some trouble with the first prong. But we'd be able to help you if we knew more. Guys, if you have questions, send them in. I think we still have, I know that the accountants, Troy, Tanya, Summer, Rachel, Jeff, Jared, Dutch, Arash, Patty was on, Matthew was on. I know these guys have been answering questions. There's well over 100. Ask a question quick if you want. They're in there. I think there's 4 open questions and they're getting them. We'll make sure that your question gets answered. If you have, if you like this type of information, you want to learn more, go to my YouTube channel, please subscribe, share it with anybody that you can. There's a lot of different content on there. There's 886 videos.
A lot.
Just a few. Clint has a channel, over 650 videos on his that are more geared towards asset protection. So if you want to learn how to invest in real estate, you want to learn the tax ins and outs and how to structure it, these are great places to start. And then you could always join us at a tax and asset protection workshop. We go over LLCs, land trusts, corporations, tax, and estate planning, including legacy planning. Lots of fun. If you have questions in the next 2 weeks, send them in. And you're answering all those questions, right? We're making sure that we're getting everything.
They're supposed to, yeah, they're supposed to go through Platinum. Yep.
Okay, we want to make, let's make sure that we get all the questions for Tax Tuesday. There was somebody saying that they didn't get an answer, that they'd emailed into Tax Tuesday. It's probably an outlier, but want to make sure that we get everybody their questions asked. This is what we like to do. Make sure that we're doing the best thing we can for folks out there. And in the meantime, thank you guys for joining us. Any last words?
No, yeah, thank you. See you next time.
Thank you guys, and we will see you in 2 weeks. Actually, you'll see them in 2 weeks. I'm not sure I'll be here. I think I'll be in California.
I think we're gonna have Miss Amanda here.
You're gonna have Amanda, Winalda, and so you guys are gonna be in great hands. And also go see Kareem. He's here on Thursday. I think I'm gonna have dinner with him that night. So I want to be able to poke fun at him. So if he does anything irregular, please email me and let me know. No, these guys did a great job, and I really appreciate you guys coming in and hanging out with us. And let anybody else know that that could benefit from this type of information, that there's a free resource. We're just doing this to help as many people as we can. It's a lot of fun. If you can't tell that we get a little goofy, but we do enjoy making sure that we're demystifying the tax code. And we've been doing this for, I don't even know how many shows, over 200 and some shows, and we'll keep doing it. And we'll see you guys later. Thanks, guys.